What you're focused on is not the spot overnight index swap, but out a couple years. Translate for mere mortals.
Yeah, absolutely. So the OIS curve, what it shows us, the forward OIS curve is the path for the Fed funds rate, not just this year, but into 2023 and 2024. And one of the things that is really interesting about the curve right now is it's actually started to invert. So the market is pricing in rate cuts in 2024. And this is unusual because the economy is still extremely strong. 500,000 average job growth per month. Yet we're seeing these cuts. And the bottom line is this will continue until the market is proven wrong. They need to see the cut happen. They need to see the economy not break down as a result of higher rates. That's the only way you get that higher terminal rate that everyone's talking about.
So for you and me, our world stops Friday night at 7 p.m. That's okay. Hold on. I'll have another drink, but I've got to read JPMorgan Weekly Prospects right now. Ferroli and Company are going to publish tonight off the Fed Speak Today. Can the Fed Speak Today move your world?
No, I don't think the Fed Speak's going to move the world. This is what I noticed from the minutes, and I know you don't like to read the minutes, but let me just tell you about what was not said in the minutes, right?
Kelsey did her research, Tom. She did her research. Carry on.
It's not about what they said, it's actually the words they didn't say. So let me tell you.
Please, go.
The words they didn't say, transitory. Transitory is completely gone from the lexicon. The two other words they didn't say, gradual or steadily or measured. They have completely refused to categorize this cycle.
So are you getting out in front of Bruce Kasman now and talking 50 beeps for sure?
Yeah. If the market is allowing it, they're going to walk through that door.
Bob Michael's there. I caught up with Bob earlier this week, Kelsey. He wants to see 50. What he said, Kelsey, was interesting, and I know you two work really closely with each other. It's what happens if we don't get a 50 basis point hike. He actually thinks we get an adverse reaction because the market starts to believe they have not got control of this. What would you look for?
Right. So the market doesn't like to be surprised, and the Fed doesn't like to surprise the market. And so if the market is pricing in a high probability of 50 basis points, the Fed should take that opportunity, take it as a blessing, and go with it. I think the thing here is that they want the market to follow the data. And the data over the last couple of weeks, we got the CPI report, we got the payrolls report with the backward revisions for the full year. All we're seeing is that the economy is still red hot. And unless Powell comes out and walks this market back, if the market is pricing 50 basis points, the Fed should walk through that door.
Well, let's talk about credit strategy now. What is it, Kelsey?
So in credit, we're still seeing some opportunities, but we really do want to start focusing on getting higher in quality and focusing on structures that are shorter duration. So that's things like securitized credit, bank loans. And I'd also like to say, we're looking at EM local this year, which is a really interesting one because you'd think with the central banks on the move, this would not be a good time for emerging market local debt. But actually, it's been one of the only areas of the fixed income market that has had positive returns. And my observation here is that EM central banks who were hiking like crazy in 2021 have actually had the foresight and the diligence that DM central banks didn't have, and were the ones that were hiking rates, now have the cushion and have been able to withstand more of this volatility this year with the DM central banks moving forward.
Kelsey, until a couple of weeks ago, the Fed has really dominated all headlines with respect to markets, and now we're being distracted or perhaps dominated by the Russia-Ukraine conflict. There's been a huge divide into what the Fed response would be and what the market response would be should the escalation continue to get worse. What's your view in terms of, does it make it more likely for the Fed to go and hike more quickly or less?
Yeah. So in the very near term, we know that treasuries serve as a safe haven, a flight to quality. They go to the most liquid point on the curve, that 7 to 10 year point. That's what's going to rally when there's a lot of uncertainty. But when I look at the minutes, going back to those minutes, they mentioned geopolitical tensions a number of times, and they only mentioned it in the context of higher inflation, upside inflation risks. So I don't think that this conflict is going to stop the Fed from removing accommodation.
This is the key concern for a lot of people who are relying on the Fed as a put, and maybe not explicitly, and they realize that it's not going to be. But what is the implication for a market that could potentially be torpedoed by an economy that's slowing in the face of these higher oil prices, in the face of faster inflation, but with a Fed that does not respond?
The Fed is in a very challenging spot. I mean, we've been saying this for a while, and it really hasn't gotten any better. So I think the Fed is going to need to watch financial conditions closely. And, at this point, financial conditions are still very easy. And so they watch that. I know they watch credit spreads. And at this point, although they are wider on the year, there isn't an issue with companies being able to get the liquidity that they need.
John, the committee expects it will soon be appropriate to raise the target range. The committee decided to have lunch. Beginning in February, the committee will increase its holding. I'm reading the damn minutes.
Is that your version
John,
of the minutes?
This is more boring than I expected.
Kelsey came out with a call this year, Tom, before almost everybody else, which was the ECB will hike this year. Kelsey, you said it in early January, then all of a sudden, week after week after week, everybody started to join in. What changes for the Fed this time around when the ECB is set to get involved as well?
So sell-offs in U.S. Treasury yields are not generally sustainable unless they're global in nature. Because what happens, and we saw this in 2014 and 2015, for example, is that when the Fed tries to go on its own, the dollar strengthens, that tightens financial conditions, and the Fed ultimately has to back down. The fact that all the central banks are moving together is very, very powerful. So the ECB, sure, they're still a long way behind the Fed. They want to see wage growth. They have to end QE before they focus on raising rates, but they're going to get there. And then I'll just say the next shoe to drop, and this is still far out in the horizon, but these are the types of things that we're really thinking about further out in the future is what happens with the BOJ and their yield curve target? What happens when Kuroda ends up moving out of the position and someone else comes in and we start to see inflation move higher? Because right now inflation there, it's still negative, but there's a lot of distortions there. So we do actually think inflation is still low in Japan, but we could be getting closer to positive inflation fairly soon.
Kuroda's the last man standing. What would drag him away from all of this, Kelsey?
So not in the near term. He's going to stay put. We just saw that the Bank of Japan continued to defend their yield curve target. So they're not in any rush. Nothing is really putting the same pressure on them. They still have negative inflation, whereas they don't need to deal with the headline of 7-8% inflation like the U.S. has. So they're not going to step away anytime soon. But when you think about what causes a more meaningful repricing and term premium across developed market nations, you have to think beyond the U.S. and you have to think about the BOJ, the ECB, and all of them moving together.